Welcome back to lesson 2 of the bond market series. In this lesson, we're going to break down the different types of bonds and organizations that issue them. You will learn the difference between government, municipal, corporate, and even international bonds. And each type of bond has its own level of risk and return and purpose in your portfolio. So this is what this lesson is going to teach you. So yeah, let's get started. So why bonds are issued. Before we get into specific types, let's quickly think back on the last video and understand why a bond exists. We need to understand that governments and companies often need money to fund many things. These can be like new infrastructure, schools, factories, or even just to refinance older debt. Rather than going to the bank, they issue bonds to the public, borrowing directly from investors like you and me. In return, they agree to pay interest and later return the full loan amount. That's the bond. So it's basically like a way to raise large amounts of money without selling ownership or control of the organization. It's very, very simple. So first things first, let's start with government bonds. These are considered the safest bonds in the market. When you buy government bonds, you're lending money to a federal government like the US or Canada, and in return, they pay you interest and eventually return your principal. So the first type of bond we have is T-bills. These are also known as treasury bills. So there are short term, they're usually under a year. Their maturities, like I mentioned, less than a year, commonly 4 to 52 weeks for 8, 13, 26, or 52 weeks. Issued at a discount, there's no coupon payments, and investors earn return when the bond matures at a face value. T-bills are short-term securities, and instead of paying interest like other bonds, they're sold at a discount to their face value. So if a treasury bill has a face value of 1,000, you might buy it for $970. And at maturity, you get the $1,000, meaning your profit is $30. So you buy it for cheaper, and then you get more when you sell it. These are popular with conservative investors and institutions looking for a safe place to park cash for a few months. Another one is a T-note. These are midterm, kind of like 2 to 10 years. That's the maturity. They pay interests, also known as coupon, every 6 months. Face value repaid at maturity. These notes are medium term government bonds. You get semi-annual interest payments called coupon payments, and then the full face value back when the bond matures. So let's say you own $1,000 in T-notes with a 4% coupon. You get $20 every 6 months until it matures, plus your $1,000 back at the end. These are widely used by investors who want steady income and are comfortable locking up money for a few years. And then last we have T-bonds, long term, they're usually over 10 years. Maturity, let's say 20 to 30. They pay interest every 6 months, and it's the longest term government bond. These are long-term investments. They pay interest every 6 months, but over a much longer period. Because they lock your money away for decades, T-bonds typically offer slightly higher interest rates to compensate for longer commitment. They're ideal for investors who want consistent income over many years, such as retirees or people planning for future expenses like college or estate planning. We do have to remember that the longer the bond term is, the more sensitive to interest rate changes, so which is something we'll cover in lesson 3. And so because governments are unlikely to default, especially developed ones, these bonds carry very low risk, but that also means the returns are usually lower, making them ideal for people seeking stability or preservation of capital like retirees. I do want to kind of tell you guys that what default is. Well, defaulting is when, let's say I'm a company and I default, it means I go bankrupt. And the chance of a government defaulting, also known as going bankrupt, is very, very low. That's why these bonds are very low risk. Next, we have municipal bonds. You call them munis, M-U-N-I-S. These are issued by your local government, kind of like your city or province, and they fund public projects like building highways, schools, or water systems. What is the big advantage? Well, many municipal bonds offer tax-free interest income, especially in the US, which can make a huge difference for high-income investors. But the risk is slightly higher than federal government bonds. Why, you may ask? Well, because cities and states can technically default, especially if they face a budget issue. So while munis are generally safe, they depend more on the financial health on local government issuing them. Obviously, the chances of your city or province or state, defaulting is very, very low, but it's still a higher risk than the full high federal government. Next, we have corporate bonds. So these are issued by businesses. This has nothing to do with the government, and these businesses are looking to raise money. These could be maybe for new factories, to buy another company, so an acquisition, or just for general growth. When you buy a corporate bond, you're lending money directly to that business. In return, they pay you interest. There is a catch though. Companies don't have the same financial strengths as government, so there's a greater risk they might miss the payment or even default. That's why corporate bonds usually offer higher yields than the government bonds, but not all companies are equal. Some are very stable and low risk, while others are very risky. That's why there are credit ratings coming in, which we'll cover in the next lesson. So a credit rating, it basically tells you how likely a bond is to default, or how risky that bond is, or how risky, or what are the chances you're going to get paid back. Usually, I'm just going to quickly tell you that AAA bonds are the best. But I'll talk about that in the next video. Or actually, I might talk about it here. I'll mention it in this video, actually. But yeah, international and emerging markets. So then we have international bonds, and these are issued by foreign governments or corporations outside of your home country. These bonds can sometimes often higher interest rates, especially in emerging markets where economic growth and inflation tend to be higher. But they also come with added risks that domestic bonds don't have. So, for example, currency risk. If the bond is issued in a foreign country and that currency loses value, your return can shrink when converted back to your own currency. Political risk. Some countries face instability, sudden policy changes, or even defaults that can directly impact whether you're getting paid or not. Regulatory risk. In some countries, investors' protections are weak. If something goes wrong, you might have limited legal recourses. So while international bonds can diversify your portfolio, which is good in a sense, and potentially also boost returns, they should be approached with extra caution and a good understanding on the risk involved. So if we put this on a quick spectrum, at low risk end, you have treasury bonds backed by the government. Then you have municipal bonds with low risk but a medium, also is low, sometimes moderate return. Investment grade corporate, which is my favorite, moderate risk but also moderate return. You get high yield, which are also called as junk bonds. I will show you where junk bonds are on the scale in lesson 3. High risk, high reward. And then emerging markets, very high risk, very high reward. But obviously, you already know this, the higher the risk, the higher return. Personally, my opinion, the best is anything here. Yes, you're not making as much money, but if you have capital and you want to be safe, you may as well just go for the lower risk and just get that lower return. So yeah, so bond ratings and credit grades. So before we wrap it up, I just want to explain what these are. So bond ratings, because not all bonds are created equal when it comes to risk. Credit rating agencies like Moody's, S&P Global, and Fitch evaluate the financial strengths of bond issuers. Their job is to answer a simple but crucial question, which is how likely is the issuer to pay back what they owe? Based on the research, they assign each bond a credit rating, which acts like a report card. So if we were to look, a AAA rating is the lowest level of credit risk. These are like beautiful, beautiful investment grade. And then right here, after you see B plus, BP, anything lower, it kind of starts to become a junk bond. So usually below BB, it's considered a junk bond. Sometimes people say B. It depends on what you're saying. Usually anything below B is for sure a junk bond. You also do want to keep in mind that credit ratings can change. If a company's financial situation worsens, its bonds can be downgraded, and that usually causes the bond price to fall, which we'll cover in the next lesson. So understanding credit rating isn't just a risk filter, it's a critical tool for building a smarter, more balanced bond strategy. I will go over this in a bit more detail when we're talking about yields. But yeah. So quickly to summarize, bonds are issued by a variety of entities. These are governments, municipalities, corporations, and even foreign countries or companies. Each type comes with its own purpose, payoff, and risk level. Government bonds are generally the safest. They're backed by the stability of the national economies, making them ideal for preserving capital. Municipal bonds help fund local infrastructure and may offer tax benefits, but their safety depends on the financial health of the issuing region. Corporate bonds come with more risk, but they can also provide higher yields, especially if the company is well managed and financially sounded. And international bonds add global diversification, but with that comes exposure to currency shifts, political instability, and regulatory differences. And so by understanding who's issuing the bond, you're not just learning about the investment, you're learning about the risk profile, income potential, and even stability behind it. This kind of insights helps you choose bonds that align with your investment goals, your risk tolerance, and your overall strategy, whether you're looking for safety, income, or even maybe a mix of both. So that's pretty much the lesson on types of bonds and their issuers. Next lesson is going to be a little more challenging when it comes to vocabulary, but this is a good lesson to put in between just so you know what types of bonds there are. And then the next lesson will be more in depth on bonds and their characteristics. See you guys in the next one.